Hi, welcome to the Devon webinar. It's our first of 2025, so great to be here, great to have you along. It's been an interesting start to the year for markets, to say the least. Obviously, a lot of focus on a certain Mr. Trump and what he's doing. Back home, it's been pretty quiet in terms of corporate announcements. There's been a few data releases of interest, including an inflation print recently, but it's about to get a lot busier as we start the earnings season in a couple of weeks' time. So here to unpick what's potentially going to come out of a few of those results is Patrick Washer, who's the portfolio manager of the Devon Dividend Yield Fund. Welcome, Patrick. How you going?
Good.
Good start to the year so far?
Yes. Yeah, no, it's been a nice start.
Excellent. We're going to unpick through a few names. And the first one is Freightways, obviously a bit of an economic bellwether. Now, we haven't had much corporate data, but we've had a bit of economic data, and the reality is we're in the worst per capita recession in over 30 years. Yeah, what are your observations around Freightways?
So Freightways would be really interesting. Their core cash generation unit, I suppose, is business-to-business courier services in New Zealand. And today, those, for really the last 2 years, same customer volumes have been down around 5%. As you suggested, New Zealand's in a really tough recession thing. So that's felt in the business community. However, we've seen more recently with business confidence picking up, other metrics like filled jobs have seemed to have bottomed from the quarterly survey of business opinion. Actual business activity seems to have bottomed, and it's coincides with, I suppose, the lagged positive movements from the Reserve Bank.
Sure. Now, you've made some observations in the past around the competitive landscape for Freightways versus its number one competitor. Remind those out there just about how you're seeing that.
Yeah, so as many industries in New Zealand do, we're a small country, so typically that lends itself to fewer market participants. And Freightways exists in what now is largely a duopoly with itself and NZ Post. And following NZ Post's over $100 million of investments made in a new facility in Auckland and a national act New Zealand First government, they're demanding that they earn better returns on the spend that they've made. So what that leads to is sector returns getting pushed up. While your courier services at home with your online shopping may feel like it's getting more expensive, the cost to move a parcel across Auckland for businesses hasn't really changed in, say, 20 years.
Yeah, well,
despite the city limits expanding quite a lot. This is a really favourable return dynamic. And as returns are increased by, say, 5% each year, we're expecting the company to continue to put up wages and roughly in line, maybe a little bit ahead of CPI, say 3%. This leads to an earnings wedge occurring where we expect margin expansion to follow.
Okay, and just one final thing on Freightways. So you're managing a dividend fund. How do you see that outlook there? And when you're looking at a bellwether like Freightways, is it buying a high quality cyclical name near the bottom or?
So this, in our opinion, is New Zealand's highest quality cyclical name. You think conventionally previous cycles, people would have bought things like Fletcher Building, which still could do well as we exit into this next phase of earnings of economic growth and things. But the company has other issues with it, with unpicks, pipes, other sort of settlements that still occur with custody and things probably. As where Freightways is much cleaner in that respect. It's just you really own a small slice of business activity throughout New Zealand, in addition to their other business units and things.
Sure. Okay, so moving on to a slightly different name. The dairy sector, I suppose we've had lots of good news on that, which has been one part of the economy which has been doing well. We've seen upgrades to the forecast farm gate milk price. But we've got A2, obviously a big name, they're due to report. What are you expecting there?
It's really interesting, A2, because since their inception, really, they haven't paid out any distributions. They've just built their cash pile, which now is getting on towards $1 billion, we'd expect. And at their November AGM, they upgraded guidance for their revenue growth from mid-single digits to mid to high single digits on EBITDA margins that were flat on last year, around 14%. However, as they move towards securing more of their own blending and canning supply chain, they had messaged the intention to start a dividend policy. And at the AGM, the company and the board initiated one, which will be 60 to 80% of underlying sort of normalised profit. And given that $1 billion cash pile they've got, as they secure some of that infrastructure I just mentioned, we see scope for, say, special dividends and total dividends to combine towards, say, $1 or so. And that remains to be seen, but we'd expect more color on that at the result. And once they start actually paying some divvies to shareholders.
And what about what's happening in China? What are you seeing there and expecting how relevant it's going to be?
It's very relevant. It hasn't stopped. A2 went from 20 cents to $20 in a market which had less babies every year, basically on average. So they have been able to successfully win market share.
And one thing which I suppose is relevant to Freightways as well, but a weaker Kiwi dollar, is that good news for A2?
Good news for exporters, I suppose, isn't it? So yeah, it all incrementally helps. It depends on the own companies. Every company has slightly different hedging policies and things. We try to view companies on a constant currency basis or like a underlying operating progress, but companies that report in actual dollars and a weak NZ currency is positive for the export sector.
Great. And there's one final one on A2. They increased their investment in Synlait late last year, right? And Synlait's come through and obviously they're going to turn a profit. Obviously a bit of a pickup in that share price from a low base. Is that good news for A2 as well?
Yeah, in accordance with Bright Dairy, the Chinese largely state-owned dairy company, Bright Dairy did most of the heavy lifting in the capital raise, but you're right, A2 did participate. And they both need each other for at least the near medium term, the next couple of years, because it remains that kind largely of something that A2's key products really in terms of the manufacturing settings. It is positive, they both work well together and both are profitable entities, but to date, the relationship's been somewhat tortured, it's fair to say.
Yeah, that's fair to say. Okay, and then finally, again, quite a different industry as well. We're talking gentailers and specifically Genesis, which I suppose is seen as the dirtier of the gentailers. What are you listed at?
It has the most carbon emissions, right? Yeah, Genesis trades on nearly a 9% gross yield for investors. It's had a difficult few years really, but with the new CEO, Malcolm McCain from Christchurch Airport, really has got his hands around the business quite well and quite quickly, and really understands the core profit drivers going forward. And one of the aspects of the thesis which is really important, they seem to be delivering on based on their operating statistics, which is the investment they've made in their own portfolio by solar and other generation assets will help offset during some of their dependence on coal-fired generation at Huntly. So what that means is Genesis burns less coal and it's cheaper and they're able to earn more money. So we think they're on track to have their second most profitable half year ever, and puts the company in a good place as they start to deliver on some other strategic initiatives.
Excellent, and also all the while getting a little bit cleaner than they were.
Greener, yeah. So another thing we're really interested to hear from the result will be further progress on the biomass supply chain. Now, we don't expect this to be achieved in a matter of months. It could be years, for instance. But as they potentially build up better relationships with tree growers and facilitate investment into the industry, as they call them, black pellets, little wood pellets, which can be stored outside for very little capex. Their current 3 coal Rankins in Huntly can be converted to this wood-fired generation use, which of course has much better carbon outcomes for themselves in New Zealand.
Excellent. It's going to be really interesting. Thanks for your time again going through those 3 companies. I'm sure it's going to be very interesting earnings season. Lots of other names that we'll be looking at in the weeks ahead. So thank you for your time today, and thanks, Patrick, once again for your time, of course. And we look forward to joining you again soon once we get into the earnings season and unpick a few more of those results. But bye for now.